Welcome to Sales Tax and More, your go-to resource for all things state tax related. Now, here is your host, Michael Fleming.
Hi, Mike Fleming here, founder of Sales Tax and More, and today's co-host of the Sales Tax and More podcast, where we talk about everyone's favorite topic, which is, of course, sales tax. Today, my co-host Ellie Mav and I are going to be going over some frequently asked questions. We got some great feedback to the last two episodes where we covered 7 frequently asked questions in each of these podcasts. So we're going to do another 7 today. But before we get started, let me introduce you to Ellie.
Hey everyone, Mike. I'm excited for this episode. We really did have great feedback on those last 2. So if you haven't listened yet, go back and listen. They are incredibly helpful. And before we get started, I am going to do a quick introduction for Sales Tax and More. Sales Tax and More is a full-service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, sales tax audits, consulting, research, and like our name states, more. End of the year is coming up, so if you need help with those services, please reach out and ask. We will give you plenty of ways to do so. We would love to help you. Back to you, Mike.
Okay. All right. So the first question, do exemption certificates expire? And rather than say it depends, like you make fun of me so often, I'm going to say some do and some don't. So you've got some states like Connecticut, it expires 3 years. Michigan expires 4 years. Maryland, 5 years. Florida, 1 year. Lots of states do expire. However, most states do not. And for those states that do not, as a best practice, we suggest updating your certificates every 3 or 4 years. And the reason why is because that certificate may have been acceptable. It probably was acceptable when it was issued. But a lot can change in 3 or 4 years. And we see so many times where something happens and that certificate that was valid when it was issued is no longer valid. In a worst case scenario, I was doing an audit of a company and they hadn't changed their certificate in 27 years. And there were multiple events. The company even changed states at one point. So that certificate is definitely not going to work for that. But it changed entity types. It changed ownership. It changed names. So anytime, there's a change in the sales tax number, that certificate becomes invalid. And other times, like in a name change, the number may or may not change that sales tax number. However, it's a red flag if you don't update the certificates, and we don't want to give auditors any more red flags than we have to. So even for the certificates that do not expire, as a best practice, every 3 or 4 years, we say every three or 4 years, because that's the audit cycles of the states. So 3 years is better at the outside. Update those certificates every 4 years.
Thank you so much, Mike. I'm going to jump right into this next question here. So a question we get often, can I write into my agreements or invoices that the customer is responsible for paying the sales use tax themselves? The answer is yes, but it will not protect you from the state. The state does not allow you to contract away from your tax collection responsibilities. If you are audited, you will need to prove that your customer paid the tax. If not, you will generally be responsible. The agreement will help you recover the tax from your customer in a lawsuit, but the state will generally not let you off the hook for this. They want their money.
Very great point, Ellie. So thanks for sharing that question. This next question's a 2-part question. And if the vendor does not charge sales tax, does the purchaser need to pay a use tax? This is someone, I think they're angling, and we hear this often, but angling how not to collect sales tax. So The answer to that first part of the question is if the vendor does not charge the sales tax, does the purchaser need to pay a use tax? And the answer to that is yes. If it's taxable, just because the vendor doesn't charge it, doesn't mean that it's a tax-free purchase. Now, here's the second part of that question. If the purchaser is required to pay a use tax, if so, can I just tell my customers to pay the use tax? And I think this ties into your question, Ellie. Can I put it in my agreements, or can I put it in there? And the answer to that is no, because if you have a responsibility, like Ellie was saying, you can't contract away that responsibility, and the state may actually go after both you and your customer. So you can't just tell all your customers to pay the use tax. The state, in theory, it can only collect the tax once, but you're going to have to prove that it was paid by your customer in order not to pay it yourself. So that tax may actually end up getting paid twice, if you're not getting that proof from your customers. So, that's not a great situation to be in. So if you have a responsibility to collect the tax, you must collect the tax or a certificate in lieu of the tax. So we can't rely on other people doing what they should. Businesses get audited, but most businesses don't, or I shouldn't say most, a lot of businesses don't pay their use tax because use tax is one of the leading causes of large assessments in audits. So companies, a lot of companies just don't pay the use tax when the vendor's not charging them the sales or use tax. And if your customers happen to be consumers, individuals, if you're selling on a B2C basis, virtually any of those customers are going to be paying the tax. So you can't just contract it away, like Ellie was saying. You can't just say, oh, well, they're going to pay it because they're responsible for paying it as a use tax. The state will come after both you and your customer. And it's up to you to prove that the customer paid it. Otherwise, you're going to be paying it out of your pocket, even if your customer did, and you can't prove it.
Yeah, thank you so much, Mike. And yeah, I'm gonna address another question here that we've seen a lot in our webinars. Really, it seems to be a lot of confusion around here. The question is, when we are over one transaction threshold but not the other, do we need to register? The answer to this is yes. It's not, it depends. We have a lot of yes or no answers today, Mike. It's a miracle. So the answer is yes. Not all states have a transaction threshold, but in most of the states that do, the word you're looking for is or. So if you cross either threshold and what you sell is taxable and your exposure is material, you should absolutely register. In the states that use the word or, the thresholds are generally what we've seen. They've all kind of gone up and down, or not up. They've gone down this year. The thresholds are generally $100,000 or 200 transactions. There right now are only 2 states that are an exception to this rule: Connecticut and New York. In these states, the word you're looking for is and, which means you need to cross both. So in Connecticut, it's $100,000 and 200 transactions, and in New York, it's $500,000 and 100 transactions. So just to circle back here, because just make sure everyone understands here, most of the time you're looking for the word or. It means yes. If you cross one of those thresholds, then you do need to register. Only 2 states with the word and there, which means both. So Mike, you're cracking up over there.
I'm sorry, Ellie. I'm just you're giving a lot of great information out there, and I'm looking at our next question, and I'm saying, okay, how do I answer this without using the word depends? Because we're on a roll. So,
we're on a roll. We really this never happened. So
yeah, it's my favorite answer. As Ellie always gives me a hard time, is it depends. So next question is, my customer keeps short paying the tax on the invoice. What should I do? So, this is a tough one. First of all, not everyone may know what short paying is. So Short paying an invoice is when they pay the entire invoice except for the tax. So they short pay it. Some companies don't, realize this. I don't know how you don't realize it, but we had one situation where there were 3 or 4 years worth of short pays from a lot of different customers. And, when you pay the tax, you're paying it on an accrual basis, not when you collect the tax. So you've remitted all this tax to the state, but your customer's not paying it. And it's their responsibility. Now, if you're catching this in the short term, you can ask for refunds or take credits if the tax is not truly due. But in this situation, this company had over $1 million in tax that was paid, but that was short paid. And some of this was actually due to the tax not actually being due. And it was falling out the back end. It was expiring. I mean, you have a statute of limitations to ask for a refund. In some states, it's 3 years. Some states, it's 4 years. So we actually saw $1 million a month falling out of statute. That's how bad this had become for this one state. Now, I know none of you out there are going to be in this bad of a situation, but if someone is short paying, you got to find out why. And maybe they are exempt for some reason. And then you got to explain to them an exempt sale is only an exempt sale if it's properly documented. So if they are saying this is exempt, they've got to get you the documentation. You got to, help them understand that if they can't get you the documentation, then they've got to pay the tax. Now, even after this explanation, some companies just don't understand, or they don't want to comply, and they're not going to pay the tax. And what do you do at that point? Well, at that point, it becomes a business decision. And you've got to decide, is this customer important enough? Are they so important to the vitality of our business that we've got to, keep this client and accept the risk? Now, if you're accepting the risk, you got to remember, it's not the tax just on that one invoice or for that one customer, because audits are done on a sample basis. It has a much bigger impact because you got to, extrapolate that error percentage across the whole population. So even one missing certificate, I mean, the example I use is in one audit we were involved with. We got all the certificates except for one. We couldn't get it excluded from the sample. We'd already used up all of our favors. And this one certificate that would have been, this one invoice would have had $8,000 on it, which is a large amount. But when they extrapolated it out across the population, $270,000. So you got to realize if you're making an exception for the client, it's not just the tax on that one invoice or on all the invoices for that client you got to worry about, but it could have a much larger impact because of the way that the audits are performed. So you got to make that decision. If they're a smaller client, I just don't think the risk is worth it. And you got to let them know, hey, if you're not going to pay the tax, then you can't be our customer. And that's a tough conversation to have. So you got to do everything you possibly can to help them understand that sales, exempt sales are only exempt sales if they're properly documented. Now, you've got to know how to help them get you the correct documentation. Maybe they really are exempt. They just can't figure out how to fill out the paperwork. So you can coach them and help them. When I say coach them, they've got to tell you what exemption they're eligible for, and then you can help them fill out the correct paperwork.
Thank you so much, Mike. And now that I just gave you such a hard time about saying it depends, it's the answer to my next question. So the next question we have here is, I have heard that sales to a business are not taxable. Is this true? And like I just said, Mike, it depends.
Oh, okay. All right. I'm sorry that you broke our we were on a roll, but At least I didn't say the word, it depends.
Yeah, I'm it's a necessary answer right now. So let me get into it a little bit here. So all sales of TPP are by default taxable unless there is an exemption. And so everybody knows out there, we use the word TPP all the time. It means tangible personal property. And just to get a little bit more about exemptions, exemptions are generally for use or by entity. So for example of that, a sale for resale is exempt if a proper resale certificate is provided. Proper means it is on the correct form, allowed by the ship to state, and completely filled out. So nonprofits are sometimes allowed to make tax-free purchases. And again, only if properly documented, our little theme we have going on here. And in most other instances, businesses are required to pay sales tax. There are some very specific limited exemptions. So in New Jersey, software that is delivered electronically and used exclusively in the business is exempt from proper documentation. If any TPP, that tangible personal property, is transferred, the exemption is not allowed. And if any personal use, the exemption is also, again, not allowed. So there is my big it depends answer for this question. And now you're free to say it, Mike, if
Oh,
it comes
well,
up.
now you understand why I use the word depends so much. I mean, you yourself are using it, and it really, hey, you gave a lot of information there, and it really depends on the specific scenarios. So, some sales to businesses are taxable and some are not. The general answer is if it's being used by the business inside for the business's own purposes, then yeah, it's taxable. So sometimes it's not, but those are very specific circumstances. So great job. Great use of the word depends.
Thanks, Mike.
All right. So I'm going to wrap this up and I don't think we need to talk about depends. Do I have to accept a certificate, whether it be resale or exempt entity certificate? And the answer is absolutely not. As a matter of fact, in some instances, you are required to reject the certificate. So this ties into the last two questions. When you're accepting a certificate, you're accepting it in what we call good faith, which means that you don't have to put on your detective's hat. So long as, it's on the right form and it's completely filled out, like Ellie was saying. One thing that I want to add there is that it has to make common sense. So for example, one of the spaces on a certificate is it asks what line of business you're in, the purchaser. And if they tell you they're a software company and they're buying one desk from you, does that make common sense that they're actually going to be reselling that desk? Well, maybe they're starting to sell desks, but then they need to put that in their business description. If they're telling you they're a software company, they're probably buying that desk to use in their own business. So that's where the common sense comes in. We do have to, use common sense in order to get that good faith acceptance. So in this instance, my recommendation would be to actually reject the certificate and charge the tax. No one is granted a God-given right to an exemption. You can reject it. It's your responsibility. You have to be comfortable with the transaction when accepting certificates. Good faith is important because if there are any problems with a certificate, if you've accepted it in good faith, then the state will go after your customer generally. And not only are there civil penalties, but there can be criminal penalties for the improper use of a certificate or the improper issuance of a certificate. You want that good faith acceptance. Now, if you're not accepting something in good faith, and this is becoming a bigger issue, if you knowingly accept a certificate where there is false information on there, and this was a big case just in the papers about Sotheby's up in New York. They were helping someone use resale certificates when these weren't sales for resale. And it was, they termed it tax evasion. They were helping their customer evade the taxes. So these criminal penalties can apply to sellers who are accepting the certificates. It's not just all on the person issuing the certificate. And in New York, since the seller should have known better, the purchaser they hit with $10 million worth of back tax fines and penalties and the like. For Sotheby's, it was 3 times that. So almost $27 million. So it can be a much bigger issue for the issuer. And sometimes you've got salespeople out there responsible for collecting the certificates, and they don't understand how important this is. They really want to make sure they hit their quotas or whatever. So they're teaching people how to avoid the sales tax. Big no-no there, because it doesn't matter if you do it, if anyone at your company is helping someone to evade taxes, which is really what you're doing when you're coaching someone on how to get an exemption that they are not responsible, they're not eligible for. That's a major no-no. So not only can you reject a certificate, in certain instances, you must reject that certificate. So if you're not comfortable, you don't have to accept it.
All right. Thank you everyone for listening in today. Thanks, Mike, for going through these questions with me. I'm just going to wrap this up by letting you guys know that if you have questions about any of our solutions or services, please reach out to me directly at eMoffat, that's EMOFFAT, at salestaxandmore.com, or visit our website, www.salestaxandmore.com. In addition to all the services we offer, we have a series of free webinars. We have a lot of resources on our website. We have a paid portion of our website that's a great research source. So again, if you have questions, please reach out, and thank you again.
Yes, thank you everyone for attending this episode of the Sales Tax and More podcast. We hope to see you again soon, and give us some feedback. Let us know how we're doing. Are there any particular types of guests that you want to see? We want to provide you information that you want to know. So thanks again, and look forward to seeing you next time. Bye-bye.
Thanks for listening. Be sure to click subscribe and check out all of the resources we have out on the web.